Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's Thursday morning, July 23rd, 2015, and the title of this week's audioblog is Unprecedented Market Manipulation Getting Swamped by Terrifying Economic Reality. Now, it's incredible just how many horrible headlines can build up in a 24-hour period. However, since yesterday morning's article, I have compiled an incredible 7 additional pages of potential material. And trust me, it didn't take a tremendous effort to find it. Today's title perfectly describes 90% of such information in depicting the gross deformation of either economic activity or the so-called markets that once measured it. Frankly, I could choose from half a dozen equally horrifying topics, but let's just say the following quote says it all, and this barely 12 hours after learning that the government-owned China Securities Finance Corporation has become one of the 10 largest holders of at least 8 major Chinese corporations, having maniacally purchased shares amidst the past month's comically blatant attempt to reverse the hideous stock crash their own psychotic policies created. From analysts at France's Societe Generale Bank, i.e. one of the largest, most insolvent banks on the planet, official validation of what the Miles Franklin blog has been vehemently claiming and quantitatively proving for the past decade. Quote, China is not alone in trying to influence equity prices, as central bankers the world over have become obsessed with asset prices, to the extent that the notion of central banks making outright purchases of equities is no longer confined to the lunatic fringe. Of course, none of these institutions are remotely interested in weighing up the long-term returns. If they were, given the absence of attractive valuations and actual cash flow growth, they might be a little more circumspect in their cheerleading. And it's not just government SocGen is attacking, but corporations, who frankly are no more responsible for their actions than hungry children. After all, CEOs are mandated with, quote, maximizing shareholder value, and in a world where value is now defined as short-term stock price gains, no matter how conflicted such results are with long-term sustainable value, what else would you expect them to do? To wit, quote, corporate executives who are rewarded for achieving EPS and share price targets, typically in the form of stock options, are also experts in the art of creating a short-term positive market impression. However, the problem with these manufactured surprises is they create a false impression, as ultimately there is no follow-through to higher future expectations, and the trend in earnings is still down. And this is no rogue analyst speaking, who somehow got his comments approved by a substitute supervisory analyst whilst the rest of France vacationed, as if one can discern the difference between French work and vacations these days. I mean, heck, CNBC itself, not on one isolated occasion, but twice in 2 days this past week, validated exactly what SocGen is stating. In first, discussing the incredibly misleading nature of earnings per share growth when driven by the reduced share counts resulting from debt-fueled share buybacks, and second, highlighting how the recent surge in equity indices like the Dow and Nasdaq have been so narrow in scope, i.e. more stocks down than up, it's difficult to figure out how they're up at all. Which is exactly, by the way, why hedge funds, or as I called them years ago, hedge bombs, have been underperforming soaring markets for years, as the so-called brilliant managers that run them still haven't figured out that it is government purchases of index futures that have driven such indices higher, not the concerted increase of thousands of individual stocks. In other words, governments have so badly deformed financial markets, the relationship with reality is no longer discernible. And thus, just like the real world, where economic Mother Nature presides, the 1% are prospering and the 99% suffering. As for said deformation, the great David Stockman coined this term to describe economically suicidal actions such as these, not just in the financial markets, but the underlying economy itself, which, in the big picture, works in tandem with financial markets. Starting with January's direst prediction of all, I have relentlessly expanded on this concept because it so perfectly describes the hideous ramifications of unfettered money printing. This week's direst prediction of all, Part 2, Mining Armageddon, was my latest such installment, dovetailing perfectly with my expertise in precious metals. However, all hail to the master, as Stockman's latest article puts this horrifying concept into perspective with some of the scariest data imaginable. To wit, this morning's must-read article, titled "Central Banks Have Shot Their Wad, Why the Casino is in for a Rude Awakening," describes just how much desperate money printing deformed the global economy since the artificial economy peaked in 2000 and permanently broke in 2008. Clearly, the Federal Reserve took the lead for so-called first world nations in the Western world, using its undeserved reserve currency status to export more inflation in 7 short years than the entire world has seen throughout history. However, history's largest capital spending bubble was led by China, where the same communist apparatchiks that created this year's historic equity bubble erroneously believed that building ghost cities on credit from both the PBOC itself and the shadow banking system it fostered could rescue the world from the clutches of the 2008 financial crisis. Clearly, Greenspan's efforts to rescue America from the 2000 to 2002 tech wreck made the 2008 crisis dramatically worse. However, the combined efforts of Bernanke's Fed, China's PBOC, and secondary players like Shinzo Abe, whose debts the IMF deemed unsustainable this morning, Mario Draghi, whose Eurozone debt hit an all-time high this week, and dozens of other central bankers have combined the current Death Star ray into such a deadly economic beam it will surely destroy everything in its path. To wit, China alone, both officially and via said shadow banking sector, added an incredible $20 trillion of debt since 2007, most of it for the construction of unneeded houses, cities, and mining and industrial capacity. Similar rates of credit growth occurred nearly everywhere else simultaneously, and consequently, amidst a debt-ridden world with many multiples more manufacturing capacity than could possibly be needed, global capital spending rose from $700 billion in the year 2000 to $2.6 trillion in 2013, i.e., quadrupling in the aftermath of the most crippling financial crisis since the Depression. Oil and gas spending alone surged from $100 billion to $700 billion, fueled in large part by the historically deformed financing of high-cost producers in the shale industry, for the most part via $500 billion of junk bonds and leveraged loans that must inevitably and likely imminently default now that the energy bubble has collapsed, and oh yeah, most of the hedges that have kept a lot of these companies alive this year are expiring this fall. And it's not just oil and gas prices that have been sentenced to multi-year, if not multi-decade death sentences, particularly now that the Iranian peace deal guarantees millions of barrels of additional overcapacity each day, but commodities in general, as I have been vehemently predicting for the past year, in countless articles, such as October's ominously titled, "Crashing Oil Prices Portend Unspeakable Horrors," which, by the way, I wrote when WTI crude was $81 a barrel, compared to $49 a barrel this morning. To that end, the Bloomberg Commodity Index achieved a new 12-year low yesterday, as not only was the oil PPT I have railed against for the past 3 months soundly defeated, but the copper PPT and all other attempts to rescue commodity prices from the aforementioned hideous fate. And even when so-called good news arises, in most cases due to manipulated data, such as this week's better-than-expected U.S. existing home sales, it is solely due to the aforementioned deformative impact of money printing and market manipulation. Like, for instance, homes in Oakland, California rocketing higher due to the residual effect of the current venture capital-inspired tech bubble, causing windfall profits for the 1% that own them and significant economic hardship for the 99% competing to rent them. And all along, housing bubble hype notwithstanding, such as yesterday's dramatic upward revision of the Mortgage Banker Association's 2015 mortgage financing estimate from $730 billion to $800 billion, and that's just for 2015 alone, as the very commodities required to actually build homes like copper and lumber experience dramatic declines on a daily basis. To that end, now that housing affordability has been utterly destroyed by a collapsing economy and Fed-inspired housing price bubble, nearly all new building permits are for multifamily rental units, which, assuming they're actually built, will take years to ease the dramatic upward pressure on rental prices currently killing the aforementioned 99%. But don't worry, the Fed claims there is no inflation, and thus ZERP to infinity inescapable. which, given the current abysmal state of the global economy, will only accelerate the current final currency war that has already destroyed the purchasing power of nearly all currencies, on average by nearly 50% over the past 4 years alone against the dollar, causing the cost of living for the 99% to surge further, whilst historically overvalued financial assets inch closer to an historic implosion, whether via Weimar-style hyperinflation or 2008-style crash. And as for precious metals, this morning's Gold Core article, titled "Gold Smash Leads to Surge in Demand for Coins and Bars Around the World," it says it all, just as it did following the infamous cartel paper raids of 2008, 11, 12, 13, and otherwise. Here at Miles Franklin, one of the nation's largest bullion dealers, we are seeing our strongest demand since the April 2013 alternative currency destruction raids, which, while it's not as powerful as the demand amidst the 2008 financial crisis, has been strong enough to contribute to the U.S. Mint suspending Silver Eagle sales for 3 weeks, whilst selling more Gold Eagles than in any month since, drumroll please, April 2013. Silver premiums and delivery times have expanded, as in 2008 and 2013, causing the so-called losses of physical holders to be far less than paper prices purport. Whilst in the world of paper PM investments, I have vigilantly warned of for more than 4 years, mining shares are at all-time lows, closed-end fund discounts to net asset value at nearly all-time highs, the supposed gold backing of the GLD ETF at 7-year lows, and open interest, i.e. government naked shorting, of COMEX silver futures at all-time highs. As noted in the aforementioned Mining Armageddon article, if the year ended today, I suspect the write-offs at many of the world's largest gold and silver miners would be so large they would be forced into bankruptcy, or at the least, dramatic financial distress that would likely lead to heavily dilutive shareholder and operations destroying mergers and or financings, which, with each passing day of cartel suppression, become more imminent, notwithstanding the comical accounting gimmickry presented in earnings results, like Newmont Mining today reporting, quote, adjusted EPS of 26 cents versus 20 cents a year ago, but GAAP EPS of 13 cents versus 37 cents a year ago. And incredibly, so-called all-in sustaining costs of $909 per ounce of gold versus $1,063 per ounce a year ago, which clearly doesn't jibe with a 65% plunge in GAAP earnings. And compared to most other miners, Newmont is in great shape, as its stock hits a level last seen in 2001 and not far from its all-time low from 1986. As for Barrick Gold, which 2 years ago I deemed evil personified for its admitted role, including with JP Morgan and the U.S. government to suppress gold prices, the world's largest gold miner, by far, appears inches from bankruptcy, with a MetroAccess.com, quote, chance of financial distress rating of a whopping 72%. With $13 billion of debt and a large percentage of production in the high-cost United States, not to mention money hemorrhaging copper and silver operations, it's nearly inconceivable that its chairman, a former president of Goldman Sachs International, will not force a horrifyingly dilutive financing or merger, which will ultimately result in an already collapsing production profile imploding further. And ditto for the high-cost South African gold mining industry, which after decades of decline, as I described in my 2013 article, The Rise and Fall of South African Gold Mining, is still the world's 6th largest producer, including holding the 3rd, 6th, and 11th largest gold mining companies in AngloGold, Gold Fields, and Harmony, as well as countless other horribly run companies, including the world's 5th largest gold miner, Kinross Gold. And now that the Canadian government has essentially put a bullet into the heart of royalty financing by qualifying years of favorable tax treatment for Silver Wheaton, replete with retroactive penalties, the ability for an industry that was already capital starved for years before this year's historic cartel attacks to save itself has never been weaker. In other words, gold production has unquestionably peaked, perhaps permanently, and as for silver production, now that base metal prices are in free fall, with the aforementioned deformative headwinds likely to persist indefinitely, the 2/3 of silver production that emanate as byproduct from such mines will likely collapse at an unprecedented rate, just as global demand explodes and inventories vanish. To wit, the world's largest base metal miner, BHP Billiton, just yesterday announced draconian production cuts in its copper operations, which undoubtedly will be matched across the entire industry and then some. Just as was the case in 2008, by the way, when the world's second largest base metal miner, Rio Tinto, nearly went bankrupt. And with it, by the way, said Silver Wheaton, when many of the silver royalty streams it owned the rights to were shut down by base metal mine closures. Unfortunately, this time around, said deformation is far worse, as described by Stockman's article. Not to mention, global central banks are tapped out. In Stockman's words, having shot their wad, hyperinflating their money supplies to stave off economic collapse post-2008. Even Morgan Stanley this very morning claimed today's oil downturn has, quote, no parallel in recorded history, with API, that is American Petroleum Institute, inventories having hit an 80-year high this week. No, not 8 or 18, but 80 years. And having personally worked as a Wall Street energy analyst from 1995 to 2005, the majority of it at Solomon Smith Barney in New York, I wholeheartedly concur. And not just related to oil and gas oversupply, but base metals, lumber, and nearly all global commodities. As opposed to gold and silver, which as I discussed in Supply Response and countless other articles, like the aforementioned Mining Armageddon article this week, with care of 15 years of cartel price suppression, like last week's Sunday Night Gold Massacre and the past 4 days of identical silver capping algorithms, have experienced a capital strangulation and industry paralysis unlike any other in history. In other words, the polar opposite of the perfect storm of oversupply experienced by the rest of the commodity industry. And putting an exclamation point on just how bad the outlook for global commodities production has become, Caterpillar, which even Jim Cramer claims to be the, quote, source of his global outlook, just reported its 31st straight year-over-year revenue decline, and this morning estimated a whopping 50% earnings decline this year from its peak 3 years ago. Which, by the way, for those morons still believing the Fed is about to destroy financial markets, the U.S. government, and its own balance sheet by, quote, tightening monetary policy, is not only due to a collapse in global demand, but the surging U.S. dollar I warned of nearly 2 years ago. In other words, the liquidity vacuum resulting from an imploding global economy is causing funds to rush into the highly liquid reserve currency, yielding exploding global inflation and competitive pressures so dramatic for U.S. companies that not only the White House, but the Fed itself on its own blog is speaking of it. To that end, I can't wait until this Wednesday's FOMC meeting, particularly if the ongoing commodity collapse and dollar surge gains momentum heading into it. To that end, consider just how maniacal this weekend's central bank manipulation meetings will be. I mean, geez, even Apple's earnings were disappointing, as the Chinese market that was supposed to fuel its growth for years experienced an incredible 21% revenue plunge from a year ago. And as for the recovering states of America, what more needs to be said than the National Retail Federation yesterday reducing its 2015 retail sales growth forecast by 15% to a level that in the real world is below inflation. Which, by the way, is captured perfectly by an article I read yesterday, showing that at age 22, Jordan Spieth, actually he'll be 22 next week, has already earned $17.4 million on the PGA Tour, compared to the $2.9 million Tiger Woods had earned by age 22 in 1998. And no, Spieth has not been better at this point, having won just 5 tournaments thus far, including 2 majors, compared to 6 for Tiger by Spieth's age, including 1 major. Well, given that this week's shenanigans have thoroughly exhausted me, I think that's enough for now. As I conclude, I see the CRB index is on the verge of losing all of today's dead cat bounce gains. In my view, the defining proof that unprecedented market manipulation is getting swamped by terrifying economic reality, which, when said reality translates into the rapidly vanishing physical gold and silver market, will likely usher in an era of monetary terror unprecedented in global history. To that end, we can only reiterate as vehemently as possible that the time is now to protect yourself while you still can. Here at Miles Franklin, we have conducted business for 26 years without a single registered complaint, and can help you not only with the purchase, sale, or storage of precious metals, but a variety of financial planning strategies we have honed over 2 decades of working with gold and silver. In fact, not only did I tape a podcast with Miles Franklin's president and co-founder, Andy Schectman, earlier this year to describe such strategies, titled Swaps, Trades, and Repatriations, which you can find on our website, but last week taped, or 2 weeks ago, taped State of the Bullion Industry, in which Andy spoke of matters investors must be aware of in the current volatile environment. As for Miles Franklin, all we ask is that you give us a call at 800-822-8080 and allow our staff of professionals, on average sporting nearly 25 years of industry experience, to give you a free consultation. As always, I can be reached via email at ahoffman@milesfranklin.com, and I look forward to seeing whoever is coming to next week's Stansberry Sprott Conference in Vancouver, where Andy and I will be speaking. Thanks, and have a great weekend.